Well, hello. I hope you don't mind, but in this talk I'm going to be a little bit contentious, or perhaps a little bit contrarian is a better word. And before I get into this, I'd like to talk to you about the subject of company valuation. Now, classically there are 9 valuation methods, and they vary from asset or book value to liquidation value, all the way down to option theory valuation. Some of these you don't even want to ask about, really you don't. But if you were to ask your advisors to value your business, if you're a private company, there is a 90%, perhaps 95% chance that your advisors will use the middle of these methods, number 5, multiples of earnings. It's by far the most commonly applied to private companies. And it works a little bit like this. Now, forgive me if you're familiar with this. There will be some that are listening to this that are not, and so I'd like to go through it very quickly. This is an actual valuation from one of our past clients. They had secured this value from their financial advisors, their auditors in fact, before they became our client. Now, we strongly disagree with this value, but I'm using it to explain the methodology behind it. We're not advocating that you go through such a process or take such a method, but I want to give you the logic behind it. You can see here on the left-hand side, we have a simplified summary of last year's statutory accounts. However, last year's accounts do not usually truly represent the underlying performance of a company. There are inevitably some adjustments that need to be made. For example, this particular company last year had reported sales of 7.8 million. However, due to some cross-charging between related companies, that sales revenue figure had been unnaturally inflated by 45,000. So their advisors reduced that figure down to 7.71 million. They had costs of goods last year at 3.8 million, but due to some stock adjustment, that was impacted by 95,000, and that in turn gave us a new gross profit of 3.975 million. Now, last year the company had a salary bill of 2.48 million. However, the current owners were planning to depart from the company at the point of sale. And the husband and wife team were taking 125,000 out of the business at the time. That salary would not continue post-sale, so the salary bill was reduced by that amount to 2,355,000. In their absence, it is likely that a new general manager would need to be appointed, so 85,000 was applied as an additional cost to the company over and above existing expenses. Last year, the company paid 36,000, 3,000 a month into the current owner's pension pot. Well, that is a cost that would stop at the point of sale, so their advisors reduced that particular cost down to 0. They had car and travel expenses last year of 65,000. Of the 65,000, 25,000 was considered to be personal expenses. And so that car and travel expense was reduced by that amount down to 40,000. They had legal expenses last year of 35,000. However, of that 35,000, 25,000 of it was considered exceptional or a most unusual expense. And so their legal costs were reduced down to a more typical for them 10,000 a year. Equipment costs. Last year 80,000, of which 30,000 was considered to be an owner's whim. So their equipment costs were dropped down to 50,000. Marketing and admin expenses in this case remained the same, but that gave us a new operating expenses figure of 2.9 million, which in turn gave us an operating profit of just over 1 million as opposed to just over 800,000 before adjustments. It is this figure that is classically used to value a business. It's now multiplied by a ratio. That ratio varies. Certain things influence the ratio, and we won't go into that right now. The most common number that you'll hear is 5. And in this case, the advisors to this particular company had indeed used a multiple of 5. 1.03 million multiplied by 5, in this case, came out with an enterprise value of 5.16 million. On top of this, surplus cash was added, which was around about 500,000, just under. Now, the multiple that you apply determines the rate of return on investment. That's actually the only point I'm trying to make here. If you use a multiple of 4, the buyer gets their money back quicker. A multiple of 6 means the buyer's got to wait a bit longer to get their money back. It's all about return on investment. Now, we strongly disagree with this thinking, and I need to explain myself. Before we move on, let me just introduce you to a phrase. You will hear the phrase multiples of earnings, multiples of EBIT, or multiples of EBITDA, earnings before interest, tax, depreciation and amortization. But it makes no difference. The multiple of whatever determines the rate of return on investment. Now let me come back to my main point. Buyers buy companies for a variety of reasons. Motives for purchase are really quite diverse. Now, the number one reason why anybody ever buys any company anywhere in the world, and by the way, this first motive dominates every other motive. There is a significant gulf between this first motive and whatever comes in second place. The number one reason why anybody ever buys a company or pays a premium price is always potential for future growth. Now, this particular motive will manifest itself classically in 3 ways. Growth through diversification. The new owner wants to get access to the products and services that you've spent perhaps many years developing. Number 2, potential for growth through new client acquisition. They want to get access to the clients that you've spent years pulling together. You can see why organic growth is so expensive and so time consuming, it becomes very attractive to gain access quickly to a strong client base. And finally, potential for growth through geographic expansion. An overseas firm wants to get a foothold here in the UK market. But potential for growth overshadows every other motive for purchase. There is a great gulf, as we've said. But there are other motives for purchase. Patents, intellectual property, certain technologies that you own may be driving this. Cyclical seasonal balancing. Defensive strategies can influence value. Operational and financial synergies. They may be looking for certain skills that you have within your workforce. It's often a mixture of these things, and it's rarely ever just one of these things, of course. Dependable income streams. And indeed, short-term return on investment. Now, getting your money back in 4, 5, 6 years is really quite short-term. And short-term return on investment has to be on our list. It is a totally valid reason for buying a company. They may be the worst type of buyer you want to sell to, but it does not make it an invalid reason for purchase. Now, this is not an exhaustive list, but if you were to prioritize this, put it in order, you will find, and this is universally accepted, the number one reason why anybody ever buys a company is potential for growth by 66%, just over. 2 out of 3 decisions that drive an acquisition are rooted in future potential for growth. It really does dominate valuation. After that, it's very difficult to rank this list, with one exception. The last motive on our list, short-term return on investment, is right where it should be, at the bottom. It is universally accepted as the rarest prime motive why anybody ever buys a company, and the rarest reason why anybody ever pays a premium price when buying a company. Now, here's my point, and I'm sure you're miles ahead of me. Why do we take the least reason why anybody will ever want to buy us, short-term investment, absolutely the least reason why they will ever pay us a decent price, short-term investment, and then we go and make that the very basis of our valuation? Doesn't make sense. Madness. And then our advisors do the single most stupid thing that goes on in our industry. They take that value that they calculated and they put it into the public domain. It's like saying car for sale for £3,000 or nearest offer. Well, guess what you're not going to get now? Never, ever, ever take a company to market with a value attached, it will probably be the most expensive mistake you make in your life. Now, we feel a bit of a lone voice in all of this, but we are completely convinced that we are right. That past value is not rooted in past performance, but future opportunity. Let me share with you an observation that's driven us to this conclusion. This is an observation of the BCMS family of companies over 30 years and selling well over 1,000 companies of all sizes. I've already said that to sell just one company, on average, we hold negotiative dialogue with many buyers. It takes us typically 4 or 5 months to reduce that list down to 50 and then down to 20 and 10. Eventually, we get that list down to 4, 5, 6 potential buyers, serious candidates. By the time we get to this last half a dozen or so, they are serious. We have been talking to them for months. They know that they've been competing with others, and they know they're down to the last 6. We've checked them out thoroughly. We've checked out their motive for purchase. We've checked them out financially. These are serious candidates. And at this advanced stage of discussion and negotiation, we now invite these final serious few to put in a competitive bid. And we do that in a particular way we haven't got time to go into right now. The difference for us between the highest offer that we receive from these final few and the lowest offer is consistently 2.5 times. This company is prepared to pay 2.5 times more than this lowest offer. Now, is there a simple reason for that? Is it because the lowest offer is so derisory, it's just easy to be 2.5 times more? The answer is no. We very rarely get derisory offers. In fact, the lowest offer is usually not that far, maybe 15 percentage points away from traditional desktop valuation, and the highest offer is 2.5 times greater. Let me give you a few examples. We sold an energy efficiency firm. Lowest offer £1 million, eventually sold for £4 million. We sold a waste management firm. We identified several hundred potential purchasers, which we reduced down to 8 candidates that were invited to make offers. The lowest offer came in at £3 million. They were trying it on a bit. That was from a company called Englefield. They were eventually purchased for 19.1 million by a company called Englefield. The same company that put in the lowest offer eventually found themselves outbidding everybody else and putting in the highest offer of 19.1 million. Now, that doesn't happen to us very often, just a few times a year, when the same company puts in both highest and lowest offer. We sold a life sciences business, lowest offer 2.9 million. They sold for 30 million. The company that bought them for 30 million started their bidding at 5 million. This next business was a more traditional second, third generation family owned business. It was in the travel sector. Lowest offer 2.97 million. They were eventually purchased by Expedia for 7 million. You see, Expedia knew this. Expedia could grow this company faster than anybody else that was bidding for it. And Expedia could grow this company further than anybody else that was bidding for it. And Expedia were prepared to outbid everybody else that was bidding for it. Value for Expedia was not so much about what this company looked like last year under the previous family's ownership, with the previous family's modest resources being applied to growth. The value for Expedia was more to do with this. What can we, Expedia, do with this company going forwards with our significant resources applied to growth? Value is about future opportunity far more than past performance. Now, your buyer will want you to think it's entirely about the past, but I guarantee you it isn't. Hardness testing machines, lowest offer 5.5 million, sold for 18.5 million. IT development integration firm, lowest offer 5 million, sold for 14.1 million. We could give you hundreds of examples. It is not about past performance, but future opportunity. That means one company is prepared to pay more than another because they're buying for a different reason. And that's frustrating because it means that you cannot value your company. Value has got little to do with multiples of past profit. It's entirely related to future opportunity. And it means you can't value a business. Don't let anybody persuade you that they can value your business with regard to selling it on the open market. It will have a dramatically negative impact on the eventual deal. So how do we get over this? How do we ensure that the buyer bids according to future opportunity? The answer lies in the bidding process itself, and we will come back to that in another video. Let me finish by confirming that value is not about looking backwards in the rear view mirror. It is not about what you did with the business going backwards, but what the new owner can do going forwards. It is about future opportunity. Now, having a choice of buyers competing with each other is what really draws this out. And we're going to talk about that in the next video.